You know what's terrifying? Right now in California, there's a financial time bomb counting down that's going to make the 2008 housing crash look like a gentle correction. And the worst part, almost nobody sees it coming. I'm not here to sell you fear or push an agenda. I'm here to show you the raw data that real estate lobbyists, state officials, and major financial institutions are desperately hoping you'll ignore. Because once you understand what's actually happening beneath the surface of this market, you'll realize why the next 18 months will change everything for California homeowners. If you want to stay informed about what's really happening in the housing market while others are left in the dark, make sure to hit that subscribe button and like this video because I'm going to share information that could save you from financial devastation. Before we dive into the numbers, let me be crystal clear about where I stand. Housing should serve families, not investors. Homes are meant to be places where you raise your children, build memories, and actually live your life, not commodities for corporations to hoard and squeeze every dollar from working people. What we've witnessed over the past 5 years isn't just unfortunate, it's fundamentally wrong. Massive corporations buying up hundreds of thousands of properties, artificially inflating rents, and then blaming ordinary people for not working hard enough to afford basic shelter. It's not just broken, it's immoral. Now, let's talk about what's really happening in California and why 2026 is going to be the year everything changes. The population exodus. Nobody's talking about California has hemorrhaged over 500,000 residents in just 3 years. That's the equivalent of the entire city of Sacramento simply vanishing. But here's where it gets genuinely shocking. While the population is declining, home prices remain 847% higher than 1990 levels. Meanwhile, incomes have only increased 189% during that same period. Let's break down what this actually means for a typical family. The median California home costs $843,000. The median household income, just $91,000. That means the average family would need to dedicate 9.3 years of their entire pre-tax income, every single dollar, just to purchase an average home. No food, no utilities, no healthcare, nothing. This isn't a sustainable market. This is mathematical insanity, and the cracks are already spreading. The tech industry implosion. Remember when everyone said the tech exodus was temporary? They were wrong. Google has eliminated 12,000 positions. Meta cut 21,000 jobs. Amazon slashed 27,000 roles. And here's what the industry doesn't want you to know. These jobs aren't coming back. According to CBRE, San Francisco's office vacancy rate just crossed 35%. One out of every three office spaces sits completely empty. These tech workers were the backbone of California's housing market, paying $4,000 monthly for tiny apartments and offering $200,000 over asking price on starter homes. Now they're relocating to Austin, Miami, and Nashville, taking their purchasing power with them. This brain drain is accelerating, not slowing down. The insurance apocalypse. Here's where things become genuinely frightening. Major insurance companies are abandoning California at an unprecedented rate. State Farm stopped writing new policies. Allstate completely withdrew. AIG is gone. The California Department of Insurance reports that over 2.8 million policies have been canceled or non-renewed in just 18 months. Think about what this means. Without insurance, you can't secure a mortgage. Without mortgages, buyers disappear. Without buyers, prices inevitably collapse. For those still fortunate enough to maintain coverage, premiums in fire-prone areas have exploded by 398%. That's an additional $15,000 to $20,000 annually, just for insurance, on top of your existing mortgage payment. Imagine dedicating your entire career to affording a California home, only to watch insurance costs consume what should have been your children's college savings. This is the harsh reality facing millions of families right now. The property tax trap California's Proposition 13 has created an untenable two-tier system. Longtime homeowners enjoy artificially low property taxes while new buyers face crushing bills. Someone purchasing that $843,000 home today will pay $2,500 annually in property taxes, while their neighbor who bought in 1995 pays just $1,200 for a comparable property. Even Warren Buffett himself highlighted this absurdity, noting that his multi-million dollar California home carried property taxes lower than a typical electricity bill. When legendary investors are pointing out systemic problems, you know the situation is serious. But here's the real danger. California faces a $68 billion budget deficit. The state desperately needs revenue. Legislative proposals are already circulating to reform Proposition 13, which would trigger massive tax reassessments overnight. Your property tax bill could jump from $3,000 to $15,000 almost immediately. This isn't speculation. We've seen identical scenarios unfold in Texas, Illinois, and New Jersey. The shadow inventory crisis. According to Realty Track, California currently has 47,000 zombie properties, homes that are vacant but not yet officially foreclosed. But that's just the visible portion. Another 182,000 homeowners haven't made a mortgage payment in over 90 days. Banks learned from 2008 that dumping distressed properties all at once craters the market instantly. So they're deliberately holding back inventory, pretending everything's stable. But with mortgage forbearance programs ending and interest rates hovering around 8%, these properties are about to flood the market. We're looking at approximately 250,000 distressed properties hitting within 18 months. The interest rate prison 78% of California homeowners have mortgage rates below 4%. At today's 8% rates, if they sell and purchase another property, their monthly payment literally doubles. A $600,000 mortgage at 3.5% costs $2,000 monthly. That identical mortgage at 8% costs $4,399, an extra $700 every single month. So nobody's selling unless absolutely forced to. Inventory has plummeted 67% below normal levels. But life doesn't stop. Divorces happen, job losses occur, medical emergencies strike. According to Federal Reserve data, 23% of homeowners will be forced to sell within 2 years regardless of interest rates. When they do, they'll have to price aggressively because buyers simply cannot afford current prices at 8% rates. The commercial real estate contagion California holds $487 billion in commercial real estate debt. With office buildings at 30% vacancy and retail corridors becoming ghost towns, defaults are skyrocketing. Commercial mortgage delinquencies just hit 9.7%, the highest level since 2009. Here's the connection that matters. Banks holding toxic commercial loans also hold residential mortgages. When commercial real estate collapses, and it will, these banks will tighten lending standards to impossible levels. Credit freezes overnight. Even qualified buyers can't secure loans. Cash becomes king, and cash buyers demand 40% discounts. The banking system fragility First Republic collapsed. Silicon Valley Bank failed, but 47 smaller California banks remain, holding over $200 billion in real estate exposure while sitting on massive unrealized losses. According to the FDIC, these institutions are underwater by $78 billion on their loan portfolios. They're technically insolvent, but still operating. When one more fails, it triggers a cascade. Depositors panic, credit lines freeze, construction stops, the entire ecosystem seizes up. And unlike 2008, the Federal Reserve can't rescue everyone. Their balance sheet is already bloated with $8.7 trillion in assets. The demographic tsunami baby boomers own 38% of California real estate, representing approximately $3.2 trillion in value. They're aging out rapidly. Census data shows 10,000 boomers turn 75 every single day. Within 5 years, we'll witness the largest intergenerational wealth transfer in American history. The problem? Their children can't afford to keep these properties. Property taxes, maintenance, and insurance costs are crushing. Gen X and millennials are already drowning in student debt and cannot take on million-dollar mortgages. These homes will flood the market through estate sales that don't wait for favorable conditions. This alone could trigger a 20-30% correction. The remote work reversal companies are mandating office returns. Amazon requires 5 days weekly. Google demands 3 days minimum. During the pandemic, millions of California workers relocated to cheaper areas while maintaining Bay Area salaries. Tahoe, Sacramento, Riverside, these markets surged 40-60% from urban refugees. Now they're being called back, but they can't afford Bay Area prices anymore. According to FlexJobs, 87% of workers say they'll quit rather than return to expensive cities. This creates a doom loop. Peripheral markets crash as remote workers leave, while urban markets can't recover because workers refuse to return. Every market segment fails simultaneously. The climate crisis reality. It's not just fire zones anymore. First Street Foundation data shows 3.7 million California properties face severe climate risk from flooding, fires, earthquakes, and mudslides. Insurance companies have run their models and know what's coming. That's why they're exiting. The state's FAIR Plan, the insurer of last resort, now covers $458 billion in property, but only maintains $2.5 billion in reserves. One major wildfire season or significant earthquake, and the entire system collapses. Uninsured properties become effectively worthless because no insurance means no mortgage availability. What this means for you. If you own California real estate, you need to seriously evaluate your position now. The convergence of these factors, population loss, insurance withdrawal, interest rate locks, banking fragility, and climate risks, creates a perfect storm unlike anything we've seen before. The government lacks the tools it had in 2008. Interest rates can't go to zero. Money printing would worsen inflation. Bank bailouts are politically impossible. The cavalry isn't coming this time. For those considering buying, wait, rent instead and preserve your capital. Let others absorb the losses that are coming. For current owners, if your situation allows selling, seriously consider it. If you're locked in, ensure you have maximum insurance coverage while it's still available. This isn't about fear mongering, this is about mathematics. When income to price ratios hit 9.3, when 78% of homeowners can't afford to move, when insurance disappears and population flees, correction becomes certain, not possible. The California dream as we knew it has fundamentally changed. The question isn't whether prices will fall, but by how much and how quickly. Understanding these dynamics now gives you the power to protect yourself from what's coming. What are your thoughts on California's housing market? Are you seeing these warning signs in your area? Drop a comment below. I want to hear your perspective on what's happening where you live. And remember to subscribe for ongoing coverage as this situation develops, because staying informed is your best defense against what's ahead.